Earlier today, we had Coca-Cola report their earnings, and it was a fairly strong set as well. When we take a look now, they are essentially down, although marginally 0.53%. We also see a two double buys from Seeking Alpha as well as Wall Street, with a strong buy on quant analysts. So is this an undervalued buy now? We're going to take a look, and also in today's episode, we want to gauge how strong of an earnings it was. Is it something we should really consider now for the portfolio, or add if it's one we have already? As always, we will do a historical analysis of the company. We're going to look at their top line revenue growth year on year, as well as their bottom line net income. We also want to ensure the safety of the company in relation to their total cash versus their total debt, ensuring it's healthy enough to continue with those dividend increases year on year. This will lead us into the dividend safety. We're going to look at some underlying metrics, free cash flow, return on invested capital, as well as some others. And as always, we're going to look at both insiders as well as the institutions to see what they have been doing quarter on quarter with this company. And don't forget, we will ultimately get it in the valuation model. What is the intrinsic value? What is our acceptable buy price, given that investor margin of safety? And what is Wall Street forecasting for the next 12 months? So let's start off with their historical performance. Now we can see they are down, in fact, over the last 12 months, -4%. And if you have been a shareholder over the last 10 years, you would be up around 51%. Now it doesn't include dividends reinvested, but even so, we can see a fairly poor return on any investment over a 10-year period. And we note it is trading towards the upper end of the 52-week range, although we do note a yield of over 3%, sitting at 3.13, with a forward P pretty much in line with the rest of the S&P at around that 22 figure. Now, before we look at the numbers, let's have an update of the earnings. How did it perform? In fact, when we look at the headline, we can see that they topped the earnings estimates, as well as hiking their revenue outlook based on higher prices. So lots of positives to take from investors. We can see they did top on both the EPS as well as the revenue. They also increased their full year organic revenue, which is always a great sign. Now, in terms of the actual numbers, for those that like to see, we can note they did beat 72 cents with 70 cents expected by the market. They also beat quite considerably on the revenue as well, just under 300 million, 11.3 billion versus 11.01. And we also note, when we look at the bottom line net income, 74 cents per share. When we compare it to the same quarter in 2023, 72 cents. So overall, looking very strong. They beat on the earnings per share. They also beat on the revenue. And one of the things that we really want to highlight is their full year outlook. Always important, so you understand where this company is heading and what they're looking for now. Forward looking on organic revenue growth, 8 to 9%, so high single digit, a very positive sign, especially when their previous range and guidance was sitting between 6 to 7%. And overall, for their earnings growth, they are anticipating between 4 to 5%. So quite a lot to like about this company. Not only are they beating their analyst targets, but they are in fact moving forwards, expecting higher organic growth. Revenue growth year on year, always important, and we always want to see a minimum of 3 to 7% growth for a very mature and steady company like Coca-Cola. When we look at it on a graph, in fact, we note the opposite, very inconsistent. In fact, it has been decreasing over the majority of the last 10 years. In 2020, where it did hit the bottom, we do note since then it has started to increase, and we will want to see that it does continue to increase over the next few years and beyond. And when we look at it numerically, it has in fact decreased from 45.998 billion to 45.754. So definitely something to keep an eye on moving forwards is that top line revenue. And whilst we note over the last 10 years, it has been very inconsistent, we also note a very, very similar story on the bottom line net income. As we can see, over the longer term, it has grown, but year on year, lots of inconsistencies, and it has gone from just over 7 billion in 2014 to just over 10.7 billion in the more recent year. So top line, very inconsistent, very minimal growth. On the bottom line, whilst we also note inconsistencies, we do at least see over the larger period around 50% growth. So positive and negative, some things just to take away when you are looking at your own investment thesis. Total cash and short-term investments versus total debt. Well, 21.7 billion of cash and short-term investments in 2014, 13.7 billion in that latest report. So we note, in fact, their cash has been decreasing over the longer term. And that's not necessarily a bad thing. It is just something that we consider when we compare it to both their total debt numerically as well as directionally. So when we analyze their total debt, in fact, it has increased, although it was very high to begin with in 2014 at just under 42 billion. We do note now it has increased marginally to 44.5. And in fact, over the longer term, there seems to be very minimal movement to that debt position, which is a positive sign, especially when you consider that their cash position does sit around 20 billion, and that will be incorporated into that dividend safety and net debt to EBITDA metric. When we take a look at their earnings per share and their estimates, we do in fact notice some seasonality with their quarter one increasing to quarter two, although we do note it is expected to decrease over the next 2 quarters, something that we can also see a very similar trend in 2023. So something just to understand, but even though it is in fact decreasing from quarter two, we still note the increases expected from the same quarter in the previous year. So something interesting, maybe something you didn't know, but we thought we would bring it to your attention. In terms of the valuation, so whilst we do see a strong buy and 2 buy ratings, we do get a D grade. Now, the reason for this is on a P non-GAAP basis, 22.04, and when we compare it to industry leaders, the average or the median, in fact, just under 18, and the same can be seen when we do look at it on a GAAP basis. So in fact, that does something carry through across to all other valuation methods. It does look pricey when you do compare it to others in the sector, but again, you could argue that Coca-Cola, just the brand alone, does carry a lot of weight and therefore is expected to trade at a slight premium to others in the industry. But again, we will look at the valuation to determine whether or not we do believe that to be true. Growth grade, well, it is a C, so not the greatest as well. Year-on-year increase, 6.39%. Fairly positive when you consider the sector median at 3.31. Forward looking slightly lower, 3.73 versus 3.92. But we also see the same consistently year on year in the other metrics, the earnings per share diluted growth year on year, the gap as well. And in fact, one thing I do like to take a look at here is the EPS on a forward looking basis over the next 5 years. 5.9% when others are expecting 8.15. Now, whether or not you believe this makes you deterrent from this company or it's just something to include in the margin of safety, the information is there to decide. In terms of profitability, well, some good news here. We get the highest grade possible, an A+. Gross profit margin, very strong, just under 60%. Sector median, around 35%. We look at the bottom line, something I always like to take a look at, 23.42%, with others in the sector much lower. And again, across the majority of other metrics, also looking very positive. Cash from operations also significantly better at 11.6 billion. Now, we can always take a look at how they performed against others in the industry in the soft drink and non-alcoholic beverages. We have PepsiCo, Monster Beverage, Dr. Pepper, a lot of these that we have in fact reviewed as well on the channel. Now, over the last year, we do see them as one of the worst performing, down 1%. This includes reinvesting those dividends, so total return, in fact, performing better than PepsiCo at negative 6%. Over the last 5 years, we also see a very similar trend, one of the worst performing, up only 49%, although we actually note that PepsiCo does outperform over the last 5 years. And when we extend it to over the last 10 years, whilst we do see not a bad return at 107%, we can see again one of the worst performing with one of their close competitors, PepsiCo, up 168%. Now let's take a look at essentially their insider ownership, and just remember, in any analysis we do, past performance is never an indicator of future performance. So insider ownership, just under 1%. We see 9 insider sales of around 89 million over the last 12 months. Now, we don't know any just yet in quarter two, but every single quarter over the last few years, we do notice some insider selling. So when we take a look at who these insiders are, we do note the more recent one, 13th of March. We have the E-Vice President sales. We notice over 57,000 shares, as we can see, for a transaction around $3.5 million, with the share price not too far off the current trading price in today's date. And again, we do notice quite a few different occasions. In fact, even the CEO at the end of February this year. As always, personal financial reasons, we don't know why they sell. Whether or not you believe it's bearish, you can add this into your investment thesis. Not something we do consider, as it is very difficult to know why. However, if we were to have seen insider buying, we would believe a very bullish signal, as insiders do buy because they believe the share price will go up. Institutional ownership over 70%. We do see just under 10 billion worth of sales by the institutions over the last 12 months, with a lot more buying over the same period. In fact, around 3.5 billion more buys. Now, when we take a look at the more recent period, we do note more selling than buying. However, in Q4, we do know the opposite. So, very different quarter to quarter, but on conclusion, we would say institutions overall are buying more on a 12-month period, but in the more recent quarter, we do note more sales than buys. Now, we are going to jump into the dividend safety, but just to let you know, we have released our latest free weekly article. If you want to gain access to any of these, all completely free, do click on the pinned comment below. We just want to point out that a lot of people in the community ask what are the websites we use. If you want to check it out, do click on this article, as that does run through every single website and resource that we use, and you can read any of these articles all completely free and instant access. Now, dividend safety, we have a score of 80. It does look to be safe. Market cap 267 billion. It is a mega cap company, and we do in fact note their dividend safety score was reaffirmed just a couple of months ago, indicating that a dividend cut is looking unlikely. So how about the last recession? For those that believe a recession is inbound very soon, well, they did in fact increase the dividend during the 07-09 crash. They had above average growth sales, negative 4.8, with the S&P at negative 12, and they also significantly outperformed the S&P, negative 31, with the S&P bringing negative 55. Dividend growth, quite nice this year, 5.4%. With this company, we do want to see above inflationary increase of over 4%. Over the last 5 years, not the greatest at 3%. Over the last 20 years, on average 7%, something we would like to see them start to go back up to, those high single-digit increases. Now, they are a dividend king. They have been increasing those dividends for 50 years or more, and we also note they have been paying a dividend for over 103 years without a reduction. Now, dividend yield theory states the company is undervalued when the current yield sits above the 5-year average. Right now, we have a sign of reasonable valuation / slight undervaluation. The same could be said on the forward P, although we do note it does trade fairly lower than the 24.2 of the 5-year average. And we do note it is slightly higher than consumer staples of 19.5. But as always, do understand we don't conclude on any of these valuations in isolation, and we will look towards doing this at the end of the episode. Free cash flow payout, we do focus on this below 70% if we do want to be industry specific for consumer staples. What we know for Coca-Cola, it has historically had a fairly high free cash flow payout, in fact around the 80% consistently, especially over the last 5 years. This is expected again in FY24, which is why we don't expect with this company for them to offer double-digit dividend increases, and that is why we have a blanket rule of under 60% for this metric, so we can hope that management do offer those double-digit increases. Free cash flow per share, as always, we love to invest in companies with increasing free cash flow year on year. Yes, it has increased over the last 10 years, but very inconsistent, very slow movement, and it is anticipated in FY24 for the free cash flow to be fairly stable. Sales growth, as we did see over the longer term, it hasn't had the greatest record. The last 3 years have been very strong. We do hope this will continue, and as we saw earlier, they are anticipating 8 to 9% in FY24, and again another format just to see the sales. In terms of shares outstanding, we want to see companies do a lot of share buybacks, another way to return excess cash to shareholders other than dividend increases. With Coca-Cola, we unfortunately don't see that. Although they have done share buybacks over the longer term, the amount is fairly trivial, as we can see, going from 4.45 billion to 4.34. ROIC, return on invested capital, one of our 7 golden dividend metrics. We want to see 10% or more just to give us faith that management are able to effectively allocate their capital. And what we can see, it is above that consistently and has been increasing over the longer term. So this does make it an attractive proposition for investors. Operating margin very strong, and we note not just above the minimum 16%, but also the operational efficiency over the longer term. And the same can be said for the free cash flow, very consistently above 7% and very strong in the 20s over the majority of the period, which is always a good sign. Finally, the net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization. Remember, this correlates to both dividend safety and balance sheet strength, and we want below 4 for consumer staples, with these numbers being the number of years it would take the company to pay off their debt net of cash on hand. We can clearly see below 4, 2.08 in 2023, expected to be below that in FY24, which is a good sign not just for the balance sheet, but also that dividend safety. Now let's jump into essentially the stock valuation model. As always, if you enjoy the content and values being provided, smash that like button, hit that subscribe and bell button so you are continually notified. So the first model, we have the multiples valuation model, companies in a similar sector and size. We have the average multiplied by the EPS of Coca-Cola to get an intrinsic value here, slightly above the current market value. So we have our first undervaluation signal. But key reminder, we're not looking at any of these models in isolation. We then have the dividend discount model with the yearly dividends and the growth rate. Now, forward looking, we have estimated 5%. Now, that is above the average growth rate, but it is below the more recent, and we do expect them forward looking to have around a 5%, slightly higher than the inflation rate, just to ensure that you aren't losing your purchasing power. Now, in terms of intrinsic value, again, we have another undervaluation signal, just under $68, with the market value just under $62. We move on to the final model, the discounted cash flow model. Now we have the free cash flow year on year, average growth rate over the longer period at 4%. Forward looking, we've gone for 10% in line with analyst estimates and targets. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we can see here another undervaluation signal with an intrinsic value of $66.50. Now, the intrinsic value is just the average of these three models, and for Coca-Cola in today's episode, it does come just under $68. Don't forget, by clicking on the pinned comment below, you can grab a copy of the valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio and those on your watch list, or even if you just want to run through these models but on your own estimates yourself. So margin of safety always stays the same. We start off with 10% and we execute if it meets our three golden criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that, well then Coca-Cola isn't too far off a 10% MOS level. It was around a $61 mark, and we can see it is trading around 74 cents above that. As always though, do let us know your thoughts in the comments below. Is Coca-Cola one you're happy with a 10% MOS level? Some people do like to pay a premium for this company. For me personally, 10% is too low. For a 15% MOS level, it would be a buy at $57, at 20% at $54, and at 25% around $50. Now, for me to add this, I would be looking at some severe margin of safety. It doesn't have many things that are very enticing for a dividend growth investor. So around $50 to $51 is where I would consider. And as we mentioned, currently does trade near a 10% MOS level. How about Wall Street? Well, as we can see, they believe upside of 7% over the next 12 months. They have a price target of $66. As always though, do let us know your thoughts. Is Coca-Cola one you are looking to add after their fairly strong earnings? If you enjoyed today's episode, smash that like button, hit that subscribe and bell button. And as always, we'll see you all on the next one.